Hello and welcome to another Wade-Gordon Signals tutorial. In this video we'll be covering the main asset groups we can trade using binary options. So without further ado, let's get into the content. There are four main assets groups that we can trade using binary options. These are stocks, indices, commodities and currency pairs. Let's start by covering stocks. Stocks are generally large multinational companies that divide their capital into shares and offer them for sale to the general public or large investors. Stocks are listed on an exchange and typically express their share price in the domestic currency to whatever exchange they're listed on. So, for example, Apple, which is listed on the US Nasdaq, is expressed in US dollars, and Tesco, which is listed on the UK FTSE, is expressed in Great British pounds. Depending on news surrounding the company, the share price will go up or down, and we, as binary options traders, can take advantage of this movement. Generally, as one would imagine, if there is good news surrounding the company such as record profit and revenue figures or increased sales figures, the share price tends to go up. If the news is bad, such as missing forecast profit or revenue figures, imposed fines, or just general scandals, then the share price tends to go down. Pretty straightforward. Stocks are the easiest assets to understand, and we recommend beginners to work with these first before moving on to more volatile assets such as commodities or currency pairs. Moving on to indices, an index is a statistical measure that represents the average performance of the top companies within a given economy or specific exchange. For example, the UK FTSE 100 represents on average the performance of the top 100 companies on the London Stock Exchange. The major global indices are shown in this list here. Indices are expressed in points, and depending on global events or released data, they will go up or down. We as binary options traders take advantage of the movement of these points. So, for example, if positive economic data was released for an economy showing a higher number of people employed in that economy, we tend to see the index related to that economy rally higher. Vice versa, if the released economic data is worse than forecast, we tend to see the index related to that economy fall. Moving on to commodities. A commodity is the term given to describe an item of which there is a demand. The main categories of trading commodities include energy, such as oil and natural gas, metals such as gold, silver, platinum and copper, and agricultural, such as coffee, wheat and corn. Depending on global supply and demand for these items, the prices of them will either go higher or lower. So, for example, if the global demand for oil remains constant, but global production is slowed for whatever reason, meaning there is less oil available, the price will go up as oil effectively becomes more precious as there is less to go around. Just a point to note, commodities unless specified are priced in US dollars, as the US dollar is the world's reserve currency. Finally, currency pairs. Currency pairs are essentially currency exchange rates and are traded on what's known as the foreign exchange market. Unlike stock markets, there is no central exchange for the foreign exchange market. It is all OTC, over the counter. The foreign exchange market is the largest of all the financial markets, with over $5 trillion being traded daily. In each currency pair, we have what is known as a base currency and a terms currency. The base currency is the one that is left listed and is equal to 1. The terms currency is the one that is right listed and is the variable. So, for example, if we see that GBP USD is at 1.5639, it means at that given point in time, £1 would get you 1.5639 US dollars. Depending on economic events or released data surrounding either economy which the currency pair relates to, the exchange rate will either go up or go down, and we can trade this movement. Taking the same example, GBP USD. If positive data was released from the UK or negative data was released from the US, the GBP USD exchange rate would tend to go higher as the pound has got stronger and the US dollar has got weaker. Vice versa, if negative data was released from the UK or if positive data was released from the US, the GBP USD exchange rate would tend to go lower as the pound has got weaker and the US dollar has got stronger. This concludes this particular tutorial. In the next lesson, we'll be covering some basic market principles. We look forward to seeing you then.